Welcome, fellow investors, to another exciting episode of Market Mastery. Today, we're about to unlock the secrets to success during a stock market crash, and we've got a special treat for you, the legendary wisdom of Warren Buffett. But before we dive into these invaluable insights, make sure you subscribe and hit that notification bell so you're always in the loop when it comes to expert investment advice. Stock market crashes can be daunting, but with Warren Buffett's timeless advice, you'll be armed with the knowledge to navigate these turbulent waters like a pro. Get ready for a masterclass in investing, because today we're uncovering the golden nuggets from one of the most successful investors of all time. Buffett's first and perhaps the most vital piece of advice is deceptively simple: don't panic. When the stock market plunges into a free fall, fear tends to drive many investors to make hasty decisions. Imagine a scenario where you find yourself as an investor during the 2008 financial crisis. The market is in a state of pandemonium and panic is contagious. Selling off your investments in a hurry may seem like a rational response to protect your capital. Unfortunately, history shows that panic-driven decisions often result in significant losses. The crucial lesson here is that while the fear during a market crash is genuine and justified, yielding to panic is rarely in your best interest. History also reveals that markets tend to recover over time. By heeding Buffett's advice and maintaining a calm, rational approach, you can better position yourself to make sound decisions even in the midst of turbulence. The second gem in Buffett's treasury of advice is keeping cash on hand. While being fully invested is vital for growth, having a readily available cash reserve can be a significant advantage during a market crash. Think of your cash reserves as a financial safety net. During a market crash, when stock prices plummet, you'll have the means to exploit the situation. You can purchase quality assets at substantial discounts, taking advantage of opportunities created by panic selling. Cash equips you with the flexibility to seize opportunities when others are in distress and selling off their assets. As Warren Buffett frequently states, it's when there's blood in the streets that the best opportunities arise. Buffett's next advice is to invest in high-quality companies. When the market is in turmoil, it's paramount to focus on businesses with strong fundamentals. Imagine companies like Apple or Amazon. These are industry leaders with proven track records of success. Even amidst market crashes, their businesses tend to remain resilient, often weathering the storm more effectively than others. The essential lesson here is that high-quality companies are more likely to withstand the market turbulence and emerge even stronger on the other side. Warren Buffett's own portfolio is brimming with such businesses that have not only survived but thrived over time. The fourth piece of advice revolves around patience. Buffett's success is firmly rooted in a long-term investment approach. During a market crash, maintaining a long-term perspective is crucial. Consider your investments as a garden. You plant the seeds and nurture them over time. When the market crashes, the temptation may be to uproot everything and start anew. However, the most fruitful gardens are those that have been cultivated over the long term. Warren Buffett often emphasizes the importance of staying the course and not being swayed by short-term market fluctuations. It's about keeping your eye on the prize and focusing on the future rather than reacting to the present. Warren Buffett's fifth advice here is to take advantage of market downturns by purchasing stocks when they are undervalued. Instead of panicking and selling off your investments at a loss when the market plunges, consider this a buying opportunity. The best investments are often made when others are fearful. It's essential to have a well-researched list of companies you'd like to invest in when the prices are right. Examining a company's debt levels is an important aspect of Buffett's investment strategy. Companies with low levels of debt are generally less vulnerable during economic downturns. High debt levels can lead to financial instability, making it challenging for a company to navigate a recession successfully. Prioritizing companies with manageable debt can reduce your investment risk. Another tip from Buffett is of understanding market psychology is essential for successful investing. Markets are driven by the emotions of fear and greed. During a stock market crash, fear can lead to panic selling, which often results in lower stock prices. Greed, on the other hand, can lead to overvaluation and market bubbles. Being aware of these emotional drivers can help you make more rational and strategic investment decisions. Warren Buffett is a lifelong learner, and this tip emphasizes the importance of continually educating yourself about the market and investment strategies. Markets evolve, and so should your knowledge. Staying informed about current events, economic trends, and new investment opportunities will equip you to make informed decisions during market turbulence. Investing in companies or industries that you're genuinely passionate about can be advantageous. Your enthusiasm can provide you with a unique perspective and a deeper understanding of the businesses you invest in. This emotional connection can help you stay committed to your investments during challenging times. During a market crash, it's common for emotions to run high, leading some investors to make impulsive decisions. However, sticking to your investment strategy is crucial. Deviating from your well-thought-out plan may lead to unnecessary losses. Stay disciplined and trust your research and strategy to guide your decisions. Buffett's final tip for today centers on the notion of focusing on intrinsic value. This involves understanding the actual underlying value of a stock or an asset. In a market crash, stocks could be undervalued, overvalued, or properly valued. By evaluating their intrinsic value, you can pinpoint hidden gems that the market may be momentarily neglecting. Warren Buffett's success, in part, is due to his knack for recognizing these opportunities during turbulent times. And that wraps up our exploration of Warren Buffett's invaluable tips for investing in a stock market crash. Remember, investing during challenging times can be an opportunity for growth and financial success if you follow these time-tested principles. If you found this video helpful, please give it a thumbs up and consider subscribing to our channel for more insightful content on investing, personal finance, and wealth-building strategies. Feel free to share your thoughts or questions in the comments section below, and we'll do our best to address them.